right now, I want to talk about what we expect from the Fed in light of this inflation. Of course, that's really the cause of all of this market turmoil. Joining us to do that is Dominique Dwor-Frecaut, macro strategist at Macro Hive. Dominique, let me start with something that Jeremy Siegel suggested yesterday. I thought very interesting. The professor from Wharton saying if the Fed comes out with a 100 basis point hike, not only does that affect inflation, but also changes the narrative, puts Powell in control of the situation, and maybe markets would react positively to that. What are you thinking? Is it possible?
So, first of all, it's not very likely. The Fed has done what the Fed does when it wants to talk to market during the pre-meeting blackout. It's reached out to trusted reporters, and it's 75 basis points. It's not 100. Then the other things that I think market participants have not focused enough on is that there's going to be a big change to the SCP. That's, some of the newspaper articles were about that the Fed, the administration made a mistake. They need to go for a much more ambitious hiking cycle. And I think the SCP is going to show unemployment above the long-term unemployment level. So basically, we're going to have a SCP that tells us more or less the Fed has given up on hopes of a soft landing, and that I think should scare markets quite a bit.
Yeah, so we will all definitely pay attention to that summary of economic projections, Dominique. So you say it's 75 that the Fed is realistically considering, because essentially that is what the market has given the Fed, to some extent, the permission to do. Do you think that the market would be happier to see a more hawkish Fed, in that it would mean that the Fed is actually going to do what it takes to get inflation under control? Powell would be more Volcker-esque, and if they're perceived as too dovish, that actually is a bad thing because it would mean inflation runs hotter for longer?
So the market would love the Fed to be able to promise that it can tame inflation without a recession. So 100 basis point, 150 basis point, no problem. The market would be very happy as long as unemployment would stay below 4%. And growth would remain above trend. That would be fantastic. We would get an extraordinary rally. But unfortunately, and again, looking at this Wall Street Journal article, it looks like what we are going to get is probably an increase in the long-term rates of unemployment. And in the intervening period, the unemployment rate climbing above the long-term unemployment rate. So, what kind of growth figure the Fed is going to put on that, I'm not sure. Maybe they will still show growth positive, but certainly they will have to show it below trend, below 2%. So
sorry, just to sorry to interrupt there. Just to reiterate then, so you think the Fed is going to start forecasting, expecting a long-term increase in unemployment, and therefore, I suppose, giving us a sense of how far they are prepared to let unemployment rise so that they can tackle inflation?
Exactly. And you see, the Fed has a problem. It's the first time that they have to raise rates to tame inflation. I mean, in the previous two hiking cycle, it was more about normalization. There was no inflation issue. But they have to do it with SCP. So they have to tell the market what the impact of raising rates is going to be a few years down the road. And it's becoming, clearer and clearer that, first of all, we have a wage price spiral. Wages are going up due to higher prices, which makes sense with the low unemployment we have. So the only way to bring down wages and inflation is to have unemployment go above the long-term estimate. And I think that's what this Wall Street Journal article is telling us, and what we are going to find out when we see the SCP tomorrow.
Dominique, thank you so much for your time. We appreciate it. Dominique Dwor-Frecaut of Macro Hive, thanks for joining us to think about where the Fed goes.